Welcome to my channel, your ultimate destination for mastering finance and business management. Whether you're looking to grow your wealth, build your business, or sharpen your skills, we've got you covered with practical tips, expert insights, and actionable strategies. Let's embark on the journey to success together. My journey to $100,000 stock portfolio as a 22-year-old investor. Are you ready? The $100,000 milestone. Why this goal matters for young investors. Building a $100,000 stock portfolio as a young investor is no small feat. It requires discipline, strategy, and a willingness to learn from mistakes. For me, it's not just about the numbers, it's about setting a strong financial foundation for life. Financial independence at a young age. Creating wealth for long-term goals like buying a home or starting a business. Starting with a small amount and consistently growing it. Overcoming challenges like market volatility, emotional investing, and learning the basics of stocks. Example, I started with just $1,000, investing in broad market ETFs. I made mistakes, but each one taught me valuable lessons about patience and research. How I got started in stock investing. The first steps on my investing journey. Starting with zero knowledge about the stock market, I immersed myself in books, YouTube videos, and investing courses. The key was to build a strong foundation before putting any money into the market. My early strategy: focus on low-cost ETFs to minimize risk. Opened a tax-advantaged account, for example, TFSA, IRA, to maximize long-term gains. First investments. My first purchase was an S&P 500 ETF, giving me exposure to the US stock market with low fees. Example, I invested $500 in an S&P 500 ETF in 2019. While it didn't feel like much, that single decision laid the groundwork for consistent growth. Key investing principles I follow. The rules that built my portfolio. Successful investing isn't about luck, it's about following tried-and-true principles. These are the rules that guided me. Consistency is key. Invest a fixed amount every month, regardless of market conditions. Diversification, spread investments across sectors to minimize risk. Think long-term, avoid emotional reactions to short-term market volatility. Example, during the 2020 market crash. I kept investing monthly, even when the market dropped. By 2021, those investments grew by 50%. Proving the value of staying consistent. Challenges I faced as a young investor. Overcoming the hurdles. Starting young has its advantages, but it also comes with unique challenges. Lack of experience. Learning about investing while avoiding scams and bad advice. Limited capital. Starting with a small amount and resisting the temptation to chase quick gains. Market volatility. Staying calm during market crashes or corrections. Example, in 2022, my portfolio dropped 20% during a market correction. Instead of panicking, I doubled down on my strategy, buying quality stocks at a discount. How I choose stocks for my portfolio. Research, analyze, invest. Stock selection is critical. I focus on a mix of growth and dividend-paying stocks while prioritizing companies with strong fundamentals. My process: research company financials, revenue, profit margins, and debt levels. Analyze the industry, growth potential, competition, and economic trends. Check valuation metrics, PA ratio, price-to-sales ratio, and dividend yield. Diversification by sector: 50% in broad market ETFs, 25% in tech stocks, 25% in dividend-paying blue-chip companies. The power of compounding. How small investments grew exponentially. Compound interest is the most powerful tool in investing. By reinvesting dividends and staying consistent, small amounts grew into significant returns. Reinvesting dividends. All dividends are automatically reinvested into the portfolio, increasing returns over time. Patience pays off. Even during downturns, compounding ensures steady growth. Example, my $1,000 investment in a dividend ETF now generates $50 annually in dividends. Reinvesting those dividends accelerates growth without additional contributions. How I manage taxes. to maximize returns, using tax-advantaged accounts to keep more of my money. Taxes can silently erode your returns, but strategic planning can help minimize this impact. I leveraged tax-advantaged accounts and focused on efficient strategies to maximize my portfolio's growth. Tax-advantaged accounts. Oh, I prioritized contributing to a TFSA tax-free savings account or Roth IRA to allow my investments to grow tax-free. Oh, dividend and capital gains were reinvested without worrying about taxes in these accounts. Tax loss harvesting. In taxable accounts, I sold losing stocks to offset gains, reducing my tax liability. Example: by holding dividend-paying ETFs in my TFSA, I avoided paying taxes on over $3,000 in dividends over 3 years, allowing my portfolio to grow faster. Handling emotional investing. Staying calm during market highs and lows. Emotional investing is one of the biggest pitfalls for new investors. Learning to manage my emotions during market turbulence was critical to building my $100,000 portfolio. Common traps: FOMO, fear of missing out, buying at market peaks due to hype. Panic selling, selling during market dips out of fear of further losses. How I overcame these traps: sticking to a plan, a predefined investment strategy helped me avoid rash decisions. Regularly reviewing my portfolio to ensure alignment with my goals. Example: in March 2020, when markets crashed, I felt the urge to sell. Instead, I reminded myself of my long-term plan and continued investing, which led to significant gains by 2021. Key milestones on my journey to $100,000. Celebrating small wins along the way. Reaching $100,000 wasn't an overnight success. It was a series of small milestones that kept me motivated. Each milestone reminded me of the power of consistent investing. Milestone 1: $10,000. Achieved through monthly contributions and compounding within 18 months. Milestone 2: $50,000. Leveraged the 2020 market dip to buy undervalued stocks. Milestone 3: $100,000. Reached by diversifying into growth stocks and ETFs while reinvesting dividends. Mistakes I made and lessons learned. Every mistake was a learning opportunity. No journey is without mistakes. I made several along the way, but each one taught me a valuable lesson that helped me refine my strategy. Chasing hot stocks. Early on, I invested in hot stocks without proper research, leading to significant losses ignoring diversification. Concentrating too much on one sector increased my risk. Overtrading. Frequent buying and selling reduced my returns due to transaction costs. My journey to $100,000 wasn't perfect, but the key was staying consistent and never giving up. If I can do it, so can you. Are you working toward your first $100,000? Share your progress in the comments below. Thank you for watching Sapric Your Finance. If you found this video helpful, don't forget to like, share, and subscribe. Hit the bell icon so you never miss our latest insights on finance and business management.